Well, Elmer, I've gotta say, I've been really impressed with your performance over the past year. Oh, thanks, boss. I've been really working hard this year. And I'm happy to let you know that you'll be getting a significant pay raise. I don't know. I don't really want to owe more taxes this year. No, Elmer, that's not how it works. I'm pretty sure it is. Have you ever heard of tax brackets? If I make any more money, I'm pretty sure I'm gonna owe more taxes this year. No, I'll just stay where I am, thanks. In fact, no, I'd like to be paid a little less, please. What? No, I got it. I'll do one better. I quit! Now I don't owe any taxes. Mwahahaha! What's up, guys? My name is Adam Nelson. Thanks so much for joining me again for another video on my channel all about money. Have you ever thought whether you should turn down a raise because you thought maybe it would bump you into the next tax bracket and maybe you would owe more taxes than it would be worth? And if you're worried about that being a dumb question, don't worry about it too much. There are no dumb questions on this channel. The only dumb question is the one that's left unasked. And if you have any other questions about money or anything, let me know in the comments below. Okay, let's get into this. Why should you not turn down a pay raise even if it will increase the amount of taxes that you're paying overall? Will you ever be paying so much more in taxes that it doesn't justify the raise that you might get? In order to answer this question, we need to understand how tax brackets work in America. In 2021, there are 7 different tax brackets, and I remember that the bottom one is at 10%, and I don't exactly remember the very top one, so I'll just post it either here or here. Okay, on this graph you'll see that there are 2 columns, one for single and one for married filing jointly. And this is referring to how you're going to file your taxes. So in order to determine which tax bracket you're going to be in, you'll need to know if you're going to be filing single or married filing jointly. Now, just so you know, there are some other filing statuses, but for simplicity, I'm going to just not talk about those today. I think probably most people fall into one of these 2 buckets. And if you don't, it's just a quick Google search away from finding out what your tax brackets are for your filing status. Okay, you'll also notice in this graph that each of the brackets has a lower bound, and the very top bracket, the 10% bracket, has a lower bound of 0. It's not written there, but it's just implied. And not all of the brackets have an upper bound. All of them do except for the very last one. The other thing you're going to need to know to understand this graph is that these values are not your base income amounts. These values are taxable income. And that's a subtle difference, but it's an important one. So you can't just say, oh, I make $75,000, I'm going to be in this bracket. That's not quite how it works. Now, when you file your taxes, you might take an itemized deduction or the standard deduction. And if you don't know which one you're going to take, you're probably just going to be taking the standard deduction. For a single person in 2021, I believe that value is $12,550. And so what that means is basically you would subtract that $12,550 from your income, from your gross income, and that's going to tell you how much taxable income you have. And if you're going to be itemizing, well, I can't tell you how much money you should subtract because that number can vary greatly. People who itemize typically donate a lot of money to charities, or they pay interest on their mortgages, or there are a few other expenses that are tax deductible. And if you have so many of these expenses that it exceeds the standard deduction, well, that's when you itemize your taxes. And so if you have a general idea of how much money you're going to be donating to charity or how much you're going to be paying in interest, this is the amount you would subtract from your base income, your gross income, I should say. Okay, so let's go through an example real quick. Let's imagine that you're single and that you make $30,000 a year. Let's also assume for simplicity's sake that you don't have any tax deductible expenses. So you're not paying a mortgage and you're not contributing a lot to charity. Let's just assume that you're going to be taking the standard deduction. Okay, so for a single person making $30,000, taking the standard deduction, we would subtract the $12,550 from the $30,000 to find the taxable income. And that amount is $17,450. And so the government is only going to be taxing that $17,450, not the full $30,000 that you make. And so this year in 2021, if that were your situation, single, making $30,000, taking standard deduction, you would be in the 12% tax bracket. And so you may be thinking to yourself, well, does that mean I have to pay 12% on that full $17,450? And the answer is no. And I think this is probably a pretty common misconception about how our taxes work. Just because you're in that 12% bucket doesn't mean that you're taxed the full 12% on all of that taxable income. In fact, each of these thresholds show us how much you're taxed for each dollar. For that $17,450 that you have as taxable income in this example, you're actually only charged 10% tax on the first $9,950. And then everything you make beyond that that falls into the 12% tax bracket, that's going to be taxed at 12%. And so your $9,950 first dollar is taxed at 12%, whereas your $9,950th is only taxed at 10%. So again, just to reiterate, it would be incorrect to say that this person in this example owes 12% on the full $17,450. That's not accurate at all. And also, if we extend this example a little bit and say that this person got a raise such that they now have $40,526 of taxable income, then we would not say that they're going to be taxed at 22% for their entire income. That's not how it works. And also, this is just federal taxes. This isn't state taxes. Those work differently, and each state is different. In fact, you may have a state that doesn't even charge income tax in your state, if you're lucky. Okay, so let's say that this person does get a pay raise, and they do end up having $40,526 of taxable income in the year 2021. And let's work through the math real quick and figure out how much this person is going to owe in taxes for this year.
Warning, this is a nerd alert. This is not a drill. The following segment may include the divulgence of deep, accumulated knowledge with a slight chance of basic arithmetic. Viewers are encouraged to seek sports gear, which may counteract the effects of the following nerdiness. Prolonged exposure may cause a permanent increase in knowledge.
Okay, so the way this works is that this person would owe 10% on the first $9,950 they make. Or in other words, they would owe $995 for the first $9,950 of their taxable income. Okay, so $995. Now again, on the $9,951st, that person's gonna owe 12% of that dollar. And that's gonna be true for every dollar up to $40,525. In other words, they'd owe another 12% in taxes on $40,525 minus the $9,950 that we've already taxed at 10%. Which means they would owe 12% on $30,575, which works out to $3,669. And so we're gonna be adding the $995 to the $3,669, and wait, there's more. So their total taxable income is $40,526. And I contrived this example on purpose like this, because on the very last dollar of taxable income that they have, they actually owe 22% on that $1. And so, in other words, we're gonna be adding another 22 cents to this amount. Okay, so the total of these three amounts, the $995 for the 10% bracket, the $3,669 for the 12% bracket, and the 22 cents for the 22% bracket, the total is $4,664.22. And this is the amount that this person owes the government in federal taxes. And something kind of neat that you can do with this number is find what's called the effective tax rate. And this is basically the weighted average of how much taxes they've paid based on which buckets or brackets they had to pay taxes in. So if we want to do some quick, rough mental math, we can see that about 1/4 of this person's taxable income was taxed at 10%. And the other, about 3/4 of that person's income, was taxed at 12%. And so we know the effective tax rate is going to fall somewhere between 10 and 12% and probably skew slightly towards the 12% number. And if we don't want to just rely on mental math to find the ballpark amount of the effective tax rate, we can actually do the actual calculation. That's not very hard. All you have to do is take the entire amount that this person owes in taxes, that's the $4,664.22 that we talked about, and we have to divide that over the entire taxable income that this person had, the $40,526. And if we do that, we see that the effective tax rate that this person is paying is 11.509%. And this kind of tax system is known as the progressive tax system, and it's really effective in ensuring that those people who make less money are actually paying less in taxes. And it also ensures that those who make more money pay a lot more in taxes. And just so you're aware of it, there's also the opposite of a progressive tax system, and that's called a regressive tax system. In the regressive tax system, a person who makes less money would have a higher tax obligation than someone who makes a lot of money. And also, just so you're aware of it, there's also another tax system called the flat tax system. And in this system, everybody pays the same percentage of their income, no matter how much money they make. And so, for example, maybe everybody pays 10% in taxes. But of course, if we went with that kind of system in America, then we probably wouldn't need to hire other people to do our taxes for us. And a lot of companies would probably go out of business. So of course we don't use that. And there's one other tax system that I want to briefly mention. It's called the no tax system. And this is a system that many libertarians like Ron Swanson would really like to see. Basically, we wouldn't owe any federal income taxes. Okay, so back to the original question. When should you say no to a pay raise? Well, the answer is never. With a progressive tax system, while yes, you're paying more in taxes with more money that you make, you never reach a point where you're paying so much more in taxes that it makes it not worth taking a pay raise. In other words, from a purely financial perspective, it's always in your favor to make more money. And I can prove this with another example. Let's say you have $1 million of taxable income. Okay, so if I did my math correctly, you would owe a total of $334,072.25. And so you would have an effective tax rate of 33.4%. 8%, which sounds incredibly high. But don't forget, you would get to keep and pocket the other $665,927.75. And so yes, you owe more in taxes the more you make, but again, it's never in your benefit to say no to a raise simply to decrease your tax obligation. So go work hard, have fun, and make more money. And if you made it this far in my video, I really appreciate you sticking around. Consider subscribing if you'd like other videos like this, and if you like this video or if you learned something new, consider hitting that like button as well. Thanks for joining me, and until next time.